Hello and welcome to the show. Now, whether you are at a family event or hanging out with friends, one topic that will not go undiscussed is the recent capping of interest rates by President Uhuru Kenyatta, which was assented into law. Now, this means that bank cannot charge more than 4% of the central bank rate, which is at 10.5% currently. So what does it mean to you as a citizen, and what are the gains and losses in the recent capping of interest rates? That's what we'll be discussing a little later on. But for now, let's have a look at the Property of the Week segment. Standing on 3 acres of land, Willow Park Homes has 72 units in total, 16 three-bedroom units, 48 two-bedroom units, and 8 one-bedroom units. All the one-bedroom units are sold out. The mahogany steel-reinforced security front door comes with a peephole that allows you to discreetly view who is standing outside your front door, allowing them into your home. Beautiful and timeless wooden laminates interweaves into the spacious living area. It offers natural appearance and warmth underfoot. A sliding door occupies one entire sitting room wall, bringing in ample natural light. Superior quality and excellence is a running theme in all areas of the house. Pay TV channel conduits are also in place. Isn't it great to have a home where you have space for everything? That's one of the advantages of an open floor living space. From the kitchen flowing down to the dining room and even the living room, where you have such a smooth flow of interaction between you, your family members and your guests as well. The kitchen is functional and has a very upmarket breakfast counter that provides additional sitting area, counter space, and storage area. There is provision for a 4 or 6 burner cooker. Soft touch cabinets and drawers come in convenient hydraulic and pull-out designs, complete the picture with magnificent display and functionality. All wet area floors are done in ceramic tiles. For privacy, a door separates the living area from the sleeping quarters. This pedestal sink provides full-sized vanity. The common bathroom is shared with visitors. The first bedroom exhibits ample wardrobes with built-in dressers and compartments. All bedrooms have TV ports and the whole house has provision for Wi-Fi. Sockets have been strategically placed where they will allow for bedside lamps. Whether it's creating a new look or complementing what's already in your bathroom, bright wall tiles set the tone and can be a profound accent onto the overall space. The master bedroom is spacious. These twin windows on either side of the bed are both functional and aesthetically pleasing. The wall-to-wall wardrobes are outfitted with a substantial range of internal storage solutions to cater for whatever you will need to store. From hanging rails to lockable drawers, everything can be accommodated and very easily reached. Shared amenities include a children's playground, a mini bar on each block, and a roof to terrace where you can hold events. Water is supplied by Kiambu Water and Sewerage Company, and there is plenty in storage while backup is from the on-site borehole. Electricity is postpaid, and in case of a power blackout, a standby generator is provided for common areas. Solar water heating system supplies all units with a constant supply of warm water. 30% of the units remain for sale. 10% deposit has to be paid upon signing letter of the offer. The 2-bedroom unit is 7.25 million and the 3-bedroom unit is 9.15 million. The project is 80% complete. Located along Banana Town right next to KPLC Power Station, this house has close proximity to socio-economic amenities, one of Nairobi's upmarket shopping centres, the Village Market, Two Rivers Shopping Mall, Rose Lane Riviera, and the Aga Khan University Hospital. Police stations include UNEP Police Post and the Gigiri Police Station and Banana Police Station. White walls can be dull and boring, and sometimes you may not really know what to do with them. Today we show you how to bring in creativity by adding flair to your space. Thinking of budgeting your money to revamp your home? No need. Bring life to your white walls with a creative and original touch. Masking tape is the perfect home decor trick. Easy to find, and it comes in all designs, sizes and color. You can become a customizing enthusiast and go all out by adding flair to your white walls. What you need: masking tape in different colors if possible, a pair of scissors. Instructions: play with lines of the masking tape. You can cut them vertically to create height or horizontally to suit a large plain wall. You can cut them into blocks or triangles, whichever suits you and your family. Let your creativity run free. This kind of decoration can be used to simply bring a difference to your white walls. You can play around with the colors and designs to be different from your child's room to the living room. Tips on decorating white walls with masking tape. Use masking tape, but before you stick it on the wall, stick it to your pants or shirt first so it collects the fibers. The fibers will keep it from ruining your wall and ruining the pictures. This is something watercolor artists use to tape their paper down to their desks or table so it doesn't curl. Some of the advantages of masking tape include: price. Masking tape is definitely cheaper. Leaves clean lines. It's available in many stores. Great option for painting window frames as it comes off of glass cleanly. Good for painting on canvas. With all these ideas, sometimes it's easy to get lost in options, and the simplest thing feels the safest and most realistic. Hence, white walls with an emphasis on furniture and art that can easily be moved and changed without a lot of work. Repainting or investing in a bold wallpaper is a bigger undertaking, and we've found a lot of people want to find something safe and simple that won't make them want to redecorate anytime soon. The masking tape is easy to remove in case you want to change to something else, but in the meantime, enjoy the simple, creative design. A lot more is coming up, but for now we take a short commercial break. We'll be right back. Welcome back to the show. Now, the capping of interest rates has become one of the most talked about topics in town. Today on the show, we want to break it down for you to understand whether it benefits you and what the disadvantages are as well. With us is Clive Akora. He is a director at KPMG. It's great to have you. Thank you so much for joining us.
Thank you for having me.
Average Kenyan who's watching and they've been hearing so much about the capping of interest rates, they don't understand what exactly it means. Can we break it down for them?
The capping of interest rate, what has happened is the Parliament has introduced a ceiling, if I may call it so, from a property perspective. It's the maximum interest that banks can charge on loans to customers. So that's been capped. Previously, what happened was each bank was at a liberty to charge the whatever interest rate it felt like. So under the new regime, there'll be a cap on the interest rates that the banks can charge, but there's also a threshold on the interest rates that banks can charge on deposits. So you sort of have a ceiling on the loans and a floor, if you may call it so, on the deposit.
For an average Kenyan who wants to take up a loan, does that mean now, what can we make them understand from that?
So banks will now be allowed to make a margin of only 4% above the central bank rate, which effectively gives an interest rate of 14.5 at a maximum. Again, on deposits, if you're going to put money with the banks, the minimum interest that the banks can give you is about 70% of the central bank rate again, which comes to a rate of around 7.35%. So you sort of have banks operating on a margin of between 14.5% and 7.35%. So you potentially, as a customer now going to a bank, you're potentially assured that the interest you'll be charged will be a maximum of 14.5. Potentially, if banks are more efficient, they can give you a rate lower than that. There's really no limit as to how low they can go on that particular.
But the maximum
but
should
the maximum
be
is set now. Yes.
All right. So that's how it directs a Kenyan. What of the banks? Because they are directly affected as well. What does this mean to them?
Banks will have to be very efficient because out of that particular margin, there are various things that they need to do. So number one, a bank has got to pay interest on the funds it receives, because a bank receives deposits and gives out those deposits as loans to customers. So number one, there's a cost on deposits, which is now again fixed. Previously, banks would give interest rates on deposits as probably as low as 2%, 3%. Now that's much higher. That increases the cost of funds. The second issue is that out of that spread that they're receiving on the interests, the banks still have got to pay their overheads. And overheads, number one, are issues like outreach costs. So now you've got banks operating on a sort of a reduced margin basis, but you've also got shareholders who still expect the banks to perform and provide the sort of profits that they've been used to in the past. So for banks, it's really going to be a struggle. And I do expect that many of the smaller banks, especially the ones which rely on customer deposits to give loans, they're going to struggle in the medium and long term.
You're saying there will be a struggle, and that will be very evident. Is there a way that then these banks can protect themselves from that?
If you get the smaller banks consolidating and creating a bigger mass, then you sort of now spread out the cost. There are profits, there are advantages to get from consolidation, and we do expect that that's going to arise in the long term. Second issue is that banks will need to be a bit more careful on who they take up as customers, essentially to protect themselves against the issue about non-performing loans.
As we discuss, I'm sure many of our viewers would wonder if banks have all these costs, then they still have to maintain. Then is there a possibility that if they cannot get profit from interest rates, that they'll probably overcharge other costs, and that affects the Kenyan directly as well?
While the banks can increase those charges, there's some regulations which enables the central bank to control the charges that the banks can levy. I think the one issue that may arise is that the banks could become more creative, essentially introducing more products which essentially generate additional revenues. We probably are going to move away from the current scenario where banks rely mostly on interest income. It probably spread out, and you find fees and commissions will start contributing much more to their bottom line than interest.
Let's have a look at the property market.
Correct.
Does this mean then that many people can invest in properties with a cap on interest rates?
There should be an increase in the people who are able to take loans to invest in property. But the other thing is, on the other side, one thing is for sure, the reduction in the cost of borrowing has got an effect throughout the economy. The people who supply building materials for the building industry, they rely on loans sometimes to either stock, to procure the materials, and their cost of borrowing is going to go down. And we do expect that hopefully these people will pass on the benefits to the developers, who then should see a reduction in the cost of property development.
I want us to look at the increase, because you mentioned about the increase in money circulating. So definitely many people would want to consume and take up loans. But is there a possibility that with increase in money, we have increase in consumption, but then no increase in production? And there could be a possible risk of inflation. Do you think there is that possibility? There
are those sorts of issues which are repercussions of essentially the reduction in the interest rate. But the National Treasury and the Central Bank have to look at the macro environment very carefully to ensure that they cushion the country against those inflationary adjustments. When you think about it, previously the banks were blamed for the interest rate. Now, if the interest rates this time are going to increase because of the CBR, it will really be at the door of the government, because banks are now restricted. So you can no longer blame banks for increasing the interest rate. Because if the CBR increases, the banks will still be making the 4% margin on the central bank rate. So again, now it will be an issue. You'll be looking at the government and saying, why is the CBR increasing?
And when we look specifically at the real estate sector, what would this mean for the real estate?
There's some bit of certainty in the market, especially in property development. And we've had the horror stories of people who take loans of 10 million. Probably 5 years down the line, the loan has gone to 50 million, and they end up losing the property when the bank forecloses on the loan. So I do expect that such instances should now be a thing of the past, because you know what the payment is going to be. And the CBR, it's been largely stable, except for the few instances where the government uses the central bank rate to essentially create macroeconomic stability. So that's probably good for the property industry.
We spoke earlier about the opportunities that are presented, but there's also difficulties that are there. And many people are worried, especially about the emergence of Shylocks. You know, so how can we go about such difficulties?
I think the government has to have conversations with the banking sector to encourage similar sort of initiatives. Be it probably if they can introduce tax incentives to essentially incentivize the banks to loan to the SME, to the property sector. I know there are some issues that the bank is addressing in terms of taxation for the property sector. People are putting up housing and stuff like that. And really, those are issues that the government should consider. As to the Shylocks and stuff, probably there's really nothing much you can do about that, because when you think about it, you cannot regulate everyone. Yeah, because I know Shylocks do not really depend on deposits. It's really money they get from elsewhere. So I think there is scope for the government to bring in set aside funds and then allow the SMEs and the other sectors to access those funds, especially for development.
Going forward, what should we expect?
Capping of the interest should not be the final thing. The government and the banking sector, they need to sit together and do a continuous review of this new regime to see whether it's working, especially the whole issue about leaving out specific sectors of the economy. If say in 6 months they do a review and find out that because of the introduction of the caps, sections of the economy are not accessing funding, then there should be a review. There should be continuing dialogue between the government and the banking sector to see how to refine this new regime to make it really work for the Kenyans.
All right. Thank you so much, Clive.
Thank you too.
Now, we've been talking about capping of interest rates, and now you know what it means to you as a Kenyan who may want to take up a loan and probably invest in property, or even those of you who work in banks. And that's where we put a cap on the show today. Thank you so much for watching. Remember, we'd love to hear your views and ideas on the topics that you would like us to bring on board. All you have to do is talk to us on our social media pages. On Facebook is NTV Property Show, on Twitter at NTV Property, and also you can call us on 0719 038847. Until next Sunday, see you then.